What is a college debt jubilee? Well, first of all, let's explain what a jubilee is. A jubilee is basically an anniversary where, from biblical days, whenever the ruling class amassed so much wealth from putting the middle and lower class people into servitude through debt, they would give them a relief, forgive all their debts. Now we're trying to have that happen in 2018 and beyond with student loans. That is what a college debt jubilee is all about. A college debt jubilee is when you become college debt free. Why did I decide to do this? Well, there's a huge college debt bubble, over $1.5 trillion. If you take a look at the student debt clock, you will see that credit cards and auto loans are actually much lower than student loan debt. In fact, if you combine them both, you get about the same bubble as student loans. Both are at 1.5 trillion. So we're looking at $3 trillion in debt between student loans, credit cards, and auto loans. And by taking a look at the US debt clock, you see student loans are actually increasing by $1,000 per second. It seems like it's even faster than $1,000 a second. To put that in perspective, when my 3-year-old son Leo goes to college, this debt will be 3 trillion or more if student loans continue to rise at the same level they do now. 6% or 9% a year, depending on which sources you see, is the average growth or cost or increase in college cost. So it's a big bubble, and the average student owes about $37,000. There are 42 million students with student loans currently, and we have about 20 million that go to college every year. Some sources say half of those get student loans, but the numbers are even bigger with people who actually go to graduate school. The 2 to 3 million that go, it's much more than half that go to college and get student loans. And the default rate on student loans are actually at about 45%. So they're very high. This is a toxic asset. And when I say the word asset, who is it an asset for? Well, in this case, it's the banks that give private student loans, and it's the U.S. government, or through Sallie Mae, that gives federal student loans. Now, private student loans are a newer phenomenon, which we can talk about later, but public student loans are the focus because they have the most flexibility, and they're the ones with options for forgiveness and ways for you to lower your payment legally. Now, I've been working with people planning and saving for their goals for more than 10 years. So why focus on student loans? Well, I've started to run into doctors who did not have discretionary income to put into vehicles that could help them save for their future. So on one hand, they could not do things like Roth IRAs because they make too much money, right? But they could not put money into other things because they didn't have the discretionary income to fund them properly. So after speaking to 21 people in the last month or so, a little bit less than a month, I've uncovered almost $3 million in student loans, with the average person having about $142,000. That's $100,000 above, higher than the average American college student, because the people I work with or tend to deal with or see having problems with their student loans or just looking for some relief are the ones who actually went to school and got a good job. They believed that you go to school, you get a good job. But these people actually ended up having the bigger loan burden, right? Much more debt on average, even though their incomes might actually not be that much bigger than the average person. In fact, a good rule of thumb is you don't want to have more in student loans than you're expected to make in your first year out of your job. So if you're going to be a doctor, you make $250,000, you don't want to have more than $250,000 in student loan debt. So that's a big mission for us. And of course, how do we make money? by saving you money on your monthly payments. So if we don't educate you and don't help you save money on your payments, we don't have a viable business. So let's take a look at this calculator. A veterinarian I recently met, we spoke about the income this person made. Luckily, they're working to improve themselves, which is wonderful, so their income will go up. But based on this loan cap calculator, their monthly maximum they should pay is about 10% of their discretionary income. So this person's payment, instead of the $4,000 a month they're expected to pay because they owe $437,000, the loan cap calculator legally allowed this person to reduce their payment to $523 a month. Now, to put this in perspective, $4,700 a month is actually the equivalent to, or more, some cases, than this person receives in net income after tax. So this was a huge relief for them, looking at what they have. $4,000 a month is the expected payment on a 10-year payback, but on income-based repayment, this person has dropped their payment to $523, which is an 89% saving for them. Wonderful. So they have gotten huge relief. And this is why we believe that most people should analyze their loans, even if you try to do this by yourself. Because some people have said, well, I could probably do this myself, right? Or could I do it myself? Yes, you can do your own taxes by yourself. But when you get a professional, they're likely to give you advice that can help you make better decisions, and you'll end up coming out ahead. Now, there's a website that you can get your personal information on your federal student loans. NSLDS. This is a National Student Loan Database. I'll just take a quick login to my own file because this is one of the main reasons I started to do this kind of work, because I have student loans myself. I graduated in 2007, withdrawn and graduated is roughly the same thing. So this is a brief idea of what we do here at College Debt Jubilee. Feel free to send me an email at andrew@collegedebtjubilee.com. You can also send me a text message if that's easier for you at 305-454-6289. I would love to help you reduce your student loan payments.